Hey guys, welcome back to my channel. Today we're going to discuss populism, economy, some economics concepts. So let's get started with a joke. There's a guy who goes to a bank and the bank teller, clerk, starts laughing and say, "You want a loan, you say? Ha ha ha, that's a good one. Where in the world did you hear that banks made loans?" Yeah, so it's a critique to the banks that have lost their purpose a lot in the past decades. Related to this is the populist or realist critique of the current society that exploits the middle class. So this representation, a single horse which represents the middle class carries the huge car of the government, and the government realizes that if the single horse, which is the middle class, bolts, we got trouble. This is a 1979 cartoon or caricature, so published in the Chicago Tribune. Ross Perot was a 1992 US presidential election candidate, the biggest third-party candidate since Teddy Roosevelt, and he helped Clinton to win. He was a billionaire from Texas, similar to what Donald Trump in 2016 did. Ross Perot was a populist like Donald Trump. He was against big government, so typical libertarian American, against big government, populist, appeal to poor people's needs, and he had good chances of winning, but he lost. He helped Clinton to win. Next joke is about inflation, very actual. It's inflation Miss Borgia. It's reference to the crimes of Borgia family in Middle Age Italy. It's inflation Miss Borgia. Too much money chasing too few poisons. If there would be more poisons, inflation, the price of the poisons would be lower. Now, jokes aside, let's jump to economics. How the supply and demand for money determine the equilibrium price level. The supply of money is fixed. The quantity of money is fixed by the central bank, except cases like the pandemic where the central bank printed money. But in general, the supply money is fixed. The demand for money is downward sloping because the people want to hold a larger quantity of money when each euro buys less. So in this case, when in the pandemic, when the supply of money increased, so the value of money decreased, right? Next, the nominal interest rate and the inflation rate are correlated. If we look at data for the British pound, let's say from 1976 to 2008, there is a close association between the nominal interest rate and the inflation rate, and this is evidence for the Fisher effect. When the inflation rate rises, so does nominal interest rate. Then we want to talk a little about the increasing openness of the world economy. There's an index of world merchandise exports from all countries, and if we set it equal to 100 in 2000, then between 1950 and 2007, for example, this only grew. And total exports is a measure of world trade. Trade has grown 3.75 times as fast as the world GDP. This shows the increasing importance of international trade and finance in the world economy.